Good morning, everyone. This is Glenn Thompson. Just a few minutes after 9 a.m. our Pacific time, our scheduled start time. And as you see on the screen, the topic for today is the U.S. dollar, analysis of the U.S. dollar. Before I begin our little commercial and just background information, if you miss any portion of today's broadcast, as I've just indicated, I've hit the record, so we do archive it on our website. And I know we used to, our computer department used to send out copies for anyone and all who have subscribed, whether or not you're present for the actual presentation. But you can, if you want to re-listen, or if you missed part of it for whatever reason, you can access the copy that we're taping or recording by contacting Pacific Trading Academy with the contact information you see on the screen. 800-339-8588 is the toll-free, as well as the website, www.pacifictradingacademy.com. All right, and as we go along, you can type questions on the right side, as you've just indicated, by letting me know you're there. As best as possible, I'll try and address them without breaking the flow of the slide presentation. If to the extent I need more comprehensive, or you prefer a more comprehensive redress, there will certainly be time at the conclusion of the slides to do so. Thank you. But I'll try periodically to kind of take a look as I'm kind of progressing, and especially if it fits with the narrative of the content I want to present. And so, all right. Just in a general sense, the U.S. dollar, I always think if we're talking about the dollar in the United States, or any currency for that matter, if we're trying to figure out its current state for the purpose of extrapolation or projection so that we can get a sense as to its probable tendencies for the future, in the broadest sense I'm aware, I always, and it's a maxim of mine as I think about how to evaluate the dollar, or any currency for that matter, I start typically from a fundamental vantage point or perspective of asking myself, if a sovereign entity, a nation state, were to issue stock, its currency would be its stock. So as the affairs of a nation go, so too will its currency. And that's typically my starting point in my efforts to evaluate what I expect or make projections for a currency. And so this initial slide just presents a basic vanilla template of typical standard intermarket correlations that exist. The dollar reflects the value intrinsically of a dollar, represents a number of factors: GDP, net trade balances, production, government investing, etc. And as the value of the dollar fluctuates, so do the other capital market sectors, commodities, treasury instruments, the nominal levels reflected by, depending on where on the interest rate curve you're interested, bonds, notes, bills, etc., the shorter end of the curve or the longer end. And finally, equities, the stock market. In general, when dollar values increase, commodities, that puts pressure on commodities. Treasury instruments are supported, as are stocks. When the currency drops in value, that allows commodity appreciation. Bonds, similarly, the nominal bond prices decline typically, and stocks follow suit. There's an interrelationship between nominal treasury instrument prices and stocks. It's a starting point of consideration. Typically, we infer that stock prices follow bonds. The stock market in general follows the bond, the 30-year, let's say. In general, there's a lag, but often that's a starting point. And then we have to adjust the aforementioned relations fundamentally, given the degree to which we're in an environment of deflation or inflation, as you see depicted. All right. Those of you who listened to presentations I've given in the past are aware that my particular area of analysis that I spend a lot of time focusing on, and I clearly realize I'm in the minority, is market timing. Timing, I believe, should always, from a cause and effect fundamental vantage point, always supersede price. Price discounts everything is the core ideal fundamental precept of the technical paradigm, and I believe and buy into that. I utilize that and depend on that. But if you are interested in a cause and effect relationship, I take an extreme view, and it's clearly not a popular one in terms of numbers, that what happens in price, all of the price fluctuations and changes, what we call price returns, from the smallest to the largest and all on a continuum of possible changes in price levels, I believe that ultimately, if you dig deep enough, it's due to certain specific periods of time elapse. So that's why I would rank in the hierarchy of tools and models that I look to help formulate my views. Timing is a very, very close, it's almost neck and neck with price, is in terms of the degree of credence I attach to it in terms of generating a reliable forecast. Right. Money flows towards greatest rate of return, especially in 2017. In the world we live, the interconnectedness in the last 20 years in particular, brought about by the increased acceleration of technological breakthroughs that have facilitated finer flows or higher velocity rates of information flow, and in turn money flow, and in turn energy flow. So money is information and energy, and a fundamental characteristic attribute peculiar to energy, money, using those two terms synonymously, is that it's always seeking its greatest, the means and the location by which it can acquire the greatest amount of sustenance or additional energy. So stated colloquially in normal English terms or basic terms, money looks for the greatest, the vehicle that will provide it with the greatest momentum, thereby increasing its value. Think about this globally. As banks function in a regulatory capacity in a given nation or country increase our price or currency supported by raising interest rates, the level of which an investment will, the increased payout of an investment, i.e. raising the rates, money tends to flow to those sectors. Whereas when a central bank through their monetary policy is softer by lowering the rates, investment values tend to decline and money is disinclined to flow towards that. That's just an overriding fundamental global context of relationship that establishes that macro dynamic. So I keep that in mind when I'm evaluating what the current state, or what I determine the current state of the currency to be, so as to give me a better sense as to how that can be projected into the future as we move forward through time. All right, so let's start bit by bit. Again, those of you who've listened to previous presentations, regardless of the subject, know that I'm primarily technical, and within that there are many, many models that one can look to help form a view and establish an idea, and ultimately for the purpose of generating a strategy that could be have utility as far as generating optimal return. I am not disavowing the fundamental approach. Certainly I just indicated a number of more intermarket ideas that are more closely attached to a fundamental view. The best of all worlds, as I see it, in terms of analysis that you utilize and for the purpose of deriving some understanding, is when you get different types of models, relationships that you look to, be they fundamental, be they quantitative, be they technical, whatever. I just view these as labels or different forms of information. I typically start with the charts, which is the normal technical approach. That allows me to generate a view. I then look or that particular view puts me in a position to ask what type of events in the world would occur, i.e. fundamentals. What events would be consistent or supportive of the view that the chart interpretation has already indicated is the most likely. So that's typically the best or the approach that I use. I cite a coworker of mine years ago to support this notion of looking for where alignments between different types of analyses might occur. His catchphrase was always, what is to encourage this and to show the shortcoming of not just so focusing on a single type of analysis. He said, what's the sound of a single hand clapping? The idea being there is no sound. So you get a result, a manifested outcome, when you combine at least more than a single formulation or idea. So one of my hierarchy of tools, again, is price, time, and thirdly on that hierarchical and analytical ladder might be something like Elliott Wave. So on that note, this is a monthly chart of the US dollar index. As you see, it's a continuation going back about 20 years or so. I presented a presentation on the US dollar, I guess it was maybe a year and a half ago, and I did the similar format where I presented a monthly count. I looked at this last night and I said I may reinterpret it or come up with a different count, but the precepts of my count a year ago or a year and a half ago are pretty much valid. If we surmise, if you can see the pointer here, the top highest point on the chart back in 2001 obviously is some type of end of a fifth wave. Those of you who are familiar with the wave principle. If you are not familiar with Elliott and the precepts and the relationships, don't worry, it's not critical. What's important is, for our purposes today, is that you get the conclusions of what I'm my argument. So if this top here back in 2001 corresponds to the end of a fifth wave, all the rapid kind of waterfall decline that went on for a period of 6 or more years into the point A, the bottom, the lowest point on the screen, that's certainly a correction. There are 5 waves that constitute the bullish appreciation stage of a market cycle, followed by a 3-wave correction, ABC. So this count is a possible explanation for the type of price action you're seeing longer term over the course. Again, this entirety shows it looking back about 20 years of price action. I typically start with a longer term view so as to provide the context, missing the details, and then I drill down to shorter and shorter time frame charts so as to fill in the more granularity or the detail, the higher resolution view. All right, so if this is the A wave, I designated all of this from this lowest point just somewhere in 2008, I guess, up to point B as the B. Again, the corrective portion of a market cycle consists of 3 waves. Standard nomenclature is to mark the endings of those respective waves with the simple little letters of A, B, and C. So B waves, the reason I ended the B wave where you see it indicated on the chart is because Bs often have a triangular type structure. So this is very B wave-like in its formation. That's a nuance of the model. Again, those of you who are familiar with Elliott Wave, great. If you're not, don't worry. Just suffice it to say, this is what was referred to as my count, or the description that adheres to certain precepts of a particular financial instrument model that allows sometimes an explanation as to the current state of a market for the purpose of generating and trying to get a better sense or a keener idea and clarity on the future. All right. So if everything from the bottom at A to B is the B, the mid portion of the correction, we have a rather short or muted or malformed C wave. But it is consistent with the real world. The real world, what actually happens, and the price action as traced out on your screen is reality. The reality of the price change, moment by moment, hour by, as we move forward through time, overrides any theoretical concept or any model or any relationship or indication. All of the models and ideas, are just that. They're collections of ideas to enable us sometimes to create some clarity out of what would otherwise be a nonlinear hodgepodge of impenetrable complexity. So sometimes we get greater clarity, sometimes we get less clarity, and thus the need to look to a few different differing types of approaches in order to pry apart the mysteries of the market. All right, so if that's the case, we have at the conclusion of the ABC, the pattern just repeats, and the repetition of this 1, 2, 3, 4, 5 ABC pattern, theoretically, according to the Elliott principle, is what serves as a driver for the purpose of propagating price action forward through time. Okay, so if that's the case, if this bottom at the first part of 2013 corresponds to the end of one cycle, a C wave, it correspondingly is simultaneously the onset of the new cycle. Wave 1, 2. Here's the thing that whether you understand Elliott or not, I want you to realize from this slide. Everything I've just said may or may not be true. What is crystal clear and what is very blatant and sticks out structurally, and as hewing to this theoretical Elliott principle, is this move from number 2 to number 3. Those of you who understand wave principle will immediately relate to this. If you don't, trust me, that is classic wave 3 type motion. What you see between number 2 on this slide and number 3 is I would say 90% certainty that is a wave 3. The formation, the way you had a succession of higher and higher tops, one right after the other. Let me just concisely state what makes it wave 3-like in its structure. Covered a lot of distance in a small period of time. Unrestricted in range very quickly. High velocity, creating a almost verticality of price action. Very third wave-like structure. Furthermore, that alone is suffice to convince me it is a wave 3 of some scale, size, or as we use the terminology, degree. If that weren't sufficient, your understanding or one's understanding of what occurs after a third forms, wave 4, and its attendant attributes that are peculiar are the opposite, very restricted in range for an unrestricted amount of time, creating more of a sideways consolidation. So if you look at everything on this slide from point number 2, and by definition each of the waves is labeled at its conclusion. So where I've penciled in the number 2, that theoretically, this adhering to the standard nomenclature of this idea, corresponds to the end of wave 2, which is one and the same as the start of wave 3. 3 marks the end of 3 and the start of 4. So if you look at everything to the right of number 3, you have very fourth wave-like activity. Whether I'm perfectly certain as to the veracity and the accuracy of everything preceding to the left of number 2 or not so, doesn't matter. To the extent at any given juncture I see structure that is consistent with the theoretical precepts, it gives me a corresponding confidence that I may be, in fact, looking at the market correctly and interpreting it correctly. And to the extent I have some sense of reliability as to the market's current state, I correspondingly I have greater confidence in how I can expect and project the market will move forward into the future. And that provides the practical utility of the Elliott principle. I don't want to get too far off on that. I hear in my teaching, people often bring up, oh, Elliott tells you everything you want to know about the past but is less helpful for the future. Even if that's not correct, sometimes it is, but it's not wholly correct. Even if it were, it's an irrelevant moot point. Nowhere, just a side note here, just from a speculative operation standpoint, a lot of traders getting started in investing feel that in order to be successful in the process of investing, you have to be able to predict the future. Complete misnomer. What I am not saying is that an understanding in any given insight you might acquire concerning probable future price returns I'm not saying that cannot help. What I am saying is it's not requisite 100% that you know the future in order to be profitable. If I have confidence in why and where the market is and why it is where it is, that by itself often gives me a significant degree of probabilistic edge in terms of my effort to profit given future motion in the market. So anyway, so suffice it to say, this brings us to the present as observed on this longer term macro chart, the monthly. Every vertical bar represents 1 month of price range. So we see a big picture, in this case going back 20 years. I believe we're either, now a little detail here as observed from the monthly, and then I'm going to drill down to show us a little more detail. Everything up to I am as I said, the thing for which I am have the greatest certainty on what you're seeing on the slide is that this space, the price action you see between number 2 and number 3, is just that. It is a number. It's a third wave. I may not. That is pretty certain, over 90% certain. And then the price action immediately following, that is to the right of number 3, I'm very certain is a wave 4. Where I'm not as certain as to whether or not we are still in the 4th wave, or did the 4th wave end possibly at the bottom where you see the pointer here. And that's about May, if I think of 2000, about a year ago, May of 16, just over a year ago. That bottom there, midway between the price of 90 and 95. It's possible that that concluded wave 4, and by the way, that's why I didn't pencil in a number 4, or it could be possible that we are still forming the 4th wave. 4th waves, just as a side note on this, folks, is to, by way of explanation, is 4th waves tend to be the most intractable, chaotic, providing the greatest challenge to understand, you want to stay out of 4th waves from a practical level. I don't care to the extent you can trade it. The bang to buck ratio is not good. I jokingly tell traders the only good thing 4th waves provide on the practical playing field is if you're selling option premium. Beyond that, stay out of 4th waves. There are plenty of other places that are easier to trade, to understand, and offer much greater opportunities. Even to the extent, again, you can figure out where and why and how a 4th wave is forming or has formed, and as such profit. The degree of reward is disproportionately small to the risk attended in general, and that's an extreme maxim. Okay, so either I would surmise at this juncture, as of the close yesterday, this bottom where my pointer, kind of around 90, maybe 94 or so in level, is the end of wave 4, in which case I would say that the following top, about 104 area and change, would be the 5th wave, albeit a muted or what we call a truncated 5th, in which case that would provide an explanation for the decline. This top here that followed this bottom, the top that comes in just under the 105 area occurred on January 3rd, as the subsequent slides will indicate. And we've been falling ever since, in through yesterday. So that's one explanation. In other words, although it's not marked on the monthly chart, this bottom that came in about a year ago marks the end or conclusion of the 4th wave. It by definition is the onset of the 5th wave, a final wave of the bull market cycle. And I would surmise, if that's the case, the 5th came in, the end of that bullish portion of the market's motion for the US dollar came in the first month, January 3rd to be particular, of this year, 2017, the first few days of the year. And what we've seen, by way of explanation for the decline we've seen ever since, it is the formation of what would be an A wave of the ABC that would ultimately form the bearish component of a market cycle. That's one viable and possible description that is consistent with the precepts of the Elliott principle. Alternatively, it's possible that everything to the right of number 3 through where we are at the present, as of the close in yesterday's market, could be we're still forming wave 4. It would be very odd, but 4th waves, again, that's why I made that little side note, tend to be quixotic, very irregular. They deviate from the theoretical script quite often, create the greatest challenges. People write books on all sorts of relationships that can be looked to help us gain a little clarity in terms of where, why, and how a fourth wave, whether it's finished, whether it's not, etc. It's you know, it's problematic at minimum, to say the least. All right, but in any case, given either scenario that seems to present as most plausible and consistent with theoretical ideas embedded in the model, it here's my point, and for whether you didn't understand anything I've just said in the last 5 minutes, or you did, the takeaway from this is that given the most likely scenarios, whether this is the fifth up here and this is in the beginning of a corrective portion of the market cycle, or if we're still in wave 4, in either case, it allows for the possibility of further declines in the US dollar. That's my point. That's the takeaway of this slide. This is the next slide. Same idea, just honing in, getting a little more telescoping in as observed from the weekly count. I've lost a little of the context. I only go back a few years now, but I see a little higher resolution. And we need both in a complementary sense. This is wave 3. This is the same data point I looked at from the previous slide up here, this top here, and that I'm pretty convinced of. And again, and I did pencil in my possible scenarios. I'm not 100% certain. One of the reasons that why I would disavow this description, this count as observed on the weekly chart, is because if this is the bottom at 92, where point 4 is the end of correction wave 4 and the onset of the impulse of wave 5, that is a very muted or truncated, as they say, fifth waves. But that's not atypical. It's just I want to qualify it as such. Fifth waves tend 70% of the time to be truncated. Sometimes that's the frequency with which you see that phenomena, that abnormality of behavior occur. The magnitude, the size of the truncation, the degree to which it is, can vary significantly, further complicating the interpretation. Sometimes in the extreme, you can have a fifth wave that's so truncated, it doesn't even exceed the peak of wave 3. In this case, it's not that truncated if in fact it is a fifth wave, but it is nevertheless shorter than ideal. Theoretical ideal calls for wave 5, the fifth wave, to extend out about 61.8. That's a Fibonacci ratio, the distance that the market moved from the start of wave 1, which was back in May a year ago, up to number 3, without going into too much detail on that. And that would bring you up into this area here, 107, 108, just eyeballing it. But again, so whether it's a fifth wave or if we're still in that would be called an irregular fourth, we're still just in a complex fourth wave that's extending, and you have what's called an irregular B. Not really, but that's the closest thing I'm aware of that it tracks, or is according to theory. And that would in this case mean that this is the, I didn't mean to jump ahead there. That would still be, this would be possibly a final leg of the correction, then we might have another wave up. In any of the two most or three most probable scenarios or wave descriptions or counts, as we call them, all of those three at least that I am focusing on augur for lower prices possibly, or at least explain the reason why we're falling off of this peak that came in. This is January of this year, January 3rd to be exact. Okay, so let's go down to the daily chart. Here's a daily. So this point number 5, if it is in fact a 5, thus the question mark, is the same 5 here that I've indicated on the weekly chart. They are one and the same data points. I'm showing it now from the vantage point of the daily chart. This is the daily chart of the June, the front month, the near contract US dollar index. DXM17 is the generic symbol, and although this chart doesn't go quite back to the start of it in May, more or less it goes back to the end of the summer, last summer in August. But you can see more or less for the entire from a year ago, May of 2016, up to the end of the year, so basically just over 6 months of rise in dollar values, up to the top of June 3. I submit that quite possibly the top that came in 3 days into the new year, our current year, corresponds to the end of the bullish component of the market cycle. If so, again, it provides a ready and convenient explanation as to why we've seen the declines from a price perspective, at least from the vantage point of this model, this particular single model, Elliott, as to why we've seen the declines. All right, and then you see structure intermittent in the ensuing months that corresponds with the structure an A, a B, and possibly a C. And that could bring, this again is yesterday's trade. This was printed out yesterday evening. So it brings us to the present. Alternatively, if this wave count vis-a-vis the previous slide, let me go back there quickly. Let's say that everything from 3, including what I'm now suggesting or relaying or utilizing as a vantage point, if I'm wrong on that, it's possible that this is maybe the A, the B, the C, the D of a triangular or extended box type longer term, more complicated wave 4, in which case I would delete this 5. I would just think of this as the, what was that, A, B, C, D, and the decline, and the reason for the decline is we're coming down in what would be the final E wave. Fourth waves, or any corrective wave, the even portions of a market cycle, wave number 2, wave number 4, 80–90% of the time will subdivide into 3 little waves, A, B, and C. The exception is often seen in fourth waves. They will sometimes further subdivide into 5 waves. That is the exception, not the rule. So that's the reason there's a little uncertainty. Is this the end of the fourth, or is this peak up here, or are we still in the fourth? If we are still in the fourth, it still provides a ready theoretical reason or explanation for the decline. It just means that we're forming the final wave of that fourth. In either case, either description, to the extent I can't more finely divide or discern between the two, that's the most likely accurate facilitator of the price action we're seeing. Even to that extent I'm unable to do so at this point, in either case, they both augur for the same type of declines we've seen all year. All right. So until further notice, if this peak on January 3rd is in fact the end of the bull market portion of the market cycle, wave 5, the reason we're coming down is it's forming A, B, and C. If instead this peak at the beginning of January 3rd is not the end of the bull cycle, but rather an internal cycle of the previous wave 4, it would be the D, the end of the D, then the reason we're coming down is not this little ABC, it's the final wave of the internal of the fourth wave. It would be labeled an E down here at whatever point it completes. In either case, though, the net general directional trend should be down by way of explanation. So that brings us to the present. Aha! To the extent I have confidence as to where and why a market is sitting or is placed or its current state, the practical utility I might be able to usurp from all of this is it gives me some edge potentially, if I can reflect on it, as to how I might expect the market will move going forward in time. And that allows me to conjecture potential relevant strategies to exploit for financial return. Okay. So let me stop. If there are any questions at this juncture, now is probably, I haven't looked at the question sheet just in case. Doesn't look like anything. Oh, maybe. You can hear me? All right, thanks. Great. Excellent. Now, what's of interest now, and that brings us to the present. And now we're going to get into a little more detail, just going forward, given my expectation of where we are, what happens based on a theoretical precept, a model, a set of ideas, if I have confidence or make an assumption as to where the market might be and to why it's there, understanding the context of where a market is with respect to a particular mental construct, a theoretical construct, allows me to, given what the model says about what happens with one precept, one wave following and forming after another, allows me to conjecture with or make guesstimates that should have expected manifested follow through greater than average probability. That's the point. So if on the premise that everything we're seeing is an ABC, what I can say is that once this C wave, if this is complete, I ask myself, what does the model say once the ABC corrective portion of a given market cycle is complete? Well, the model says once that occurs, with a market, in order to continue moving, the driver for its continued existence is a new cycle begins. So that would say if at whatever point this entire decline completes and you see structure supportive of that, what does the theory tell us? It should break up into three little parts, A, B, and C. When that completes, what happens theoretically? A new cycle begins. You go back to the starting point of the game. You repeat, you iterate the function in a sense. You just repeat ad infinitum. And this constant ad infinitum follow through is what serves for the future, the propagation of the system forward as we move forward through time. So that would tell me, on an assumption that this is actually over, I would be bullish the US dollar in a vacuum, not factoring in or taking into account any other variables, any other modifying or amelioratory agents out there in the world external to the market. Theoretically, all I can say is, to the extent, based on a theoretical set of relations, once the corrective portion of the cycle is complete, what does theory tell me ensues then? What happens to be consistent with the theory? It says that a new cycle begins. And it's always a cycle that starts with a wave one, and the directional trajectory or angle of the first wave is always in the same direction as the preceding wave one of the preceding cycle. And so if I ask myself what that was, it would clearly be or provide for me an impetus to think in terms of being bullish or price supportive for the US currency. All right. Now, little detail here. And this is, you can break it up separately. Those of you who are familiar with Fibonacci ratio analysis, most people are, if they've been investing for any time, at least in the technical model. Most people, you apply it for price. You should. I also apply it in time. Whatever you do to price, you should do to time, vis-a-vis what I mentioned earlier about time is way more important as a causative agent for what you see in price. Okay. But here's the important point. I don't want to belabor this. If you look at this longest bar on the chart, that's November 9th, remember, of 2016. That's the election. That's the volatility. If you looked at that for a range that begins with that bottom all the way up to the top for the year 2017, it's the highest point from a year ago, January 3. We've been in the net translation in price has come down. Well, there's certain magnitudes or degrees of retracement that have reversal ramifications. You may be familiar, 61.8, 78.6, 50, 38.2, 50, 61.8 are the three most important Fibonacci ratios that have reversal ramifications. Well, you can see where we are, and of late, and I wrote a report about a week ago where I said, notice this little double bottom here. This was May 22nd, where I have my pointer, and May 23rd. One day right after another, the markets touched down precisely to the tick at the 88.6 Fibonacci level. And that level in price was 97, 90, I'm sorry, I'm trying to remember the number, it just 96.70 in particular. And as such, I esteem that to be of important support. And I wrote that to the extent the market respects that or doesn't will be provide some insight, or should provide further clarity as to the future, at least short-term course for the dollar. So you can see we bounced off of it for about a week or a little week and a half or so, and then just in the last few sessions completing, we closed yesterday just below. Current level, the market closed yesterday in the dollar June front month contract at 96.67, albeit not far from the zone of what was support at 96.70, but it is significant that the close, not just the intra-period or intraday activity, broke through that support, but it closed below, so that represents a consensus view of the dollar. I can interpret that as weakness. Possibly, there's all sorts of fundamental vectors and forces and things. We had the slowing of the jobs, slowing in jobs growth as indicated by the report, the non-farm payroll report yesterday. There will always be external triggers fundamentally or that serve to initiate whatever you're catching or deriving or ascertaining from your chart interpretation. There's always got to be a reason that on this what I call the topical or superficial level is more readily available for the masses to think about, manipulate, calculate, play with, and to present for the news. If it wasn't that actually occurred, it would have been something else. This is why very often amidst the complexity of the plethora of information that can be released makes it a daunting task, at least for myself, to try and cut through all that mishmash of detail of information as it's released. Especially, I always tell people one of the problems we have in the world today in terms of analysis is the exact opposite of what existed at the early 1900s. Back then it was a scarcity or a dearth of information and it moved at a snail's pace. Today it's the mirror image. We are overwhelmed with information and the velocity with which it's moving makes it further. I can't identify, the uncertainty principle comes into play. To the extent I could track and identify its current position is the extent to which I can't get a bead on its momentum. To the extent I can see its vector or trajectory is the extent to which I don't know its position. And so that creates a tremendous challenge in differentiating the signal to noise ratio of information. That is a chief prohibitive factor of analysis to trading today. But suffice it to say, here's an important point that gives me a little bit of a clue, though not definitive, as to at least the immediate course I expect for the U.S. currency. The fact that it broke through, albeit there was a piece of news, a relatively soft jobs report yesterday, and what is the market? The dollar just here is an incorporation. I'm going to take what the chart is telling me and try and see if there's a dovetailing or a fitting or a piece or a structure of news events setting up in the real world, that topical, superficial stuff you hear about, if to the extent you're tuned into events as they bubble up on the surface of information, that might work in concert so as to create a probabilistic edge in my paradigm that I'm expecting that would be supportive of my viewpoint. Well, to the extent we have a weak report is the extent to which the dollar market in this case might perceive that the central bank, which is scheduled to meet in 2 weeks, middle of June, might be disinclined to raise rates as they've been indicating and the mounting tendency of collective thought has been for the last few months since the last time they raised them in March. That's why that would be an explanatory note that makes some sense. I'm not saying it's actual, but I'm just saying it could fit the description of the real world, what we saw, and provide a valid, plausible explanation as to why the market broke through this Fibonacci technical level. Nevertheless, the precept of analysis on the technical front says price discounts everything. Whether you know it or don't know it, the price internally understands and comprehends all of that which you know and that which you don't. So if I don't know anything about how to interpret the relations as they go on that high level of information as it's released, as complex as that can be, I can at least, to the extent I read the language of the market as observed on a two-dimensional time price plot, a chart of dollar prices, and understand certain relationships once it broke down below a key zone of support. Basic TA 101 tells me having a market breaking through a zone of support or resistance and you want to, and someone comes along and asks, or in your mind you conjecture, what's next? What do I think is going to happen next? Well, your starting point of analysis is, having broken through support or resistance, the market is more likely on the continuum of probabilities, the spectrum of odds, to continue moving in the same direction that it was moving as it broke through that, in what was previously an impenetrable wall of either excess supply or demand, as from the vantage point of an economist. Same concept, just two different vantage points. Supply, demand, support, resistance. Excess supply, excess demand, a bottom of price or a top, a ceiling, either way. And there are certain specified levels that are more important. Now, I will say, just as a note to argue the opposite view of being bullish, the 88.6 level of degree of retracement of a previous trend is a powerful reversal indication. So my point is, it's a very subtle one, nevertheless a profound one if it is in and of itself, though not definitive. And that is, if the market had stopped at this level like it did two times before a few weeks ago, May 22nd, May 23rd, back-to-back, forming a classic double bottom, had it stopped yesterday, or even if it had closed above it, even though on an intra-period basis, if it had broken and violated that level, that would have modified and that would have softened my bearish view, given the tendencies of historic correlation. When a market retraces that degree of an important preceding trend, it tends 75% to reverse. The fact that it didn't respect it, albeit it didn't in an egregious fashion blow through, but the consensus view, albeit slightly, broke through, is a slight indication pushing me more towards further declines. How far? To the next, well, basic, simplistic, to the next lower level of underlying support. That would be down here, where I've drawn this horizontal line, the price level around 95.70 area, or 95, just under 95.80. You see, so we closed again yesterday, 96.67. Given just the price action in the last few, well, in particular yesterday, what does that tell me in and of itself? Expect further declines. That's qualitative indication. How quantitatively it could go down as far as the next level of support, which is down to this area here, 95.70, 95.80 area. That's a short-term projection just based on the higher degree of detail that the daily chart provides, that is consistent with either of the two primarily plausible wave descriptions that the longer term, weekly and monthly indications of price action for the longer view provided. Moving on. Relative to my strong footing and focusing on market timing, from a cause and effect standpoint, here's just a brief look at the possible rotations. The vertical lines as observed on this screen indicate just a few of the past time targets that I projected. The significance of any one of these vertical lines for our purposes now is simply to indicate change and to convey the primary thrust of that change, trend reversal. That's not perfectly precise, but one obvious type of change that certainly from a practical standpoint is convenient and helpful to a trader from practical purposes in their effort to max and optimize their financial return on investment, is a 180-degree reversal where a market forms a top or a market forms a bottom. This is January. The reason I put in the past lines is just to show kind of give you a back-tested indication or a cursory anecdotal sense of the reliability of this. I'm about between 70 and 80% reliable, given the confluence of varying ideas that I utilize to project time points out in the future. The top actually came in 2 days, January 3. This is the same daily chart of the front month in the US dollar. January 3rd, I was 2 days late. So it was pretty good. If the models that I utilized to generate that, I would say it was close. It was not perfect, but it was close. Actually, it was perfect. This line, though you can't see it, was exactly on a bottom. Now, that may or may not have, in a real sense, generated for the given or provided to the trader any real edge, but it is what it is. It was a perfect hit. It was not perfect, but it was a close hit as far as the obvious, real, significant top that was pivotal and obviously could have, in retrospect, if not in the moment, in real time, given a trader significant edge. Even if you didn't realize it. Having seen, even if you got in here, clearly we've been moving down ever since. So that was a valid hit, even though it wasn't perfect. Even though it was perfect to the day that it was. It was a bottom here, though you can't see it. But the next one that I came in, close, similar. Again, May 24 was the actual date. We had the 23rd, so, and the 22nd. That was the double bottom. This at exactly at the 88.6 level of retracement of the move from this bottom, November 9, all the way up to the January 3rd top. So that was close. Whether or not one would have been able to derive an advantage that would manifest and translate to profitable returns in of equity, I don't know. That's a secondary, albeit important point. But what's important theoretically is it giving us a valid, reliable indication of a reversal? To the extent it does, is you want to pay attention. My next one on the timeline is out. This is where this is useful potentially for the future. June 16th. That's of interest because it's roughly congruent with the Fed meeting, FOMC, meeting 2 weeks from now. So I'm not surprised. Could be coincidence, might not be, I don't know. I doubt it's coincidence. Might be though. All it tells me when the market, when collectively we in our observance of what the system is doing gets to this point, is to have a greater than average expectancy for a change, one type of which is an outright trend reversal. The line itself in the purity doesn't indicate it doesn't say if it's going to, even to the extent it proves in retrospect to be reliable, I don't know at the time I'm looking at this now whether in fact, even if it's a perfect hit, whether it's going to be a top or a bottom, even should that occur. All this indication graphically, all the data itself is just that. It's a time point. In this case, it's stated in a date. And that's all it at most tells me with perfect certainty. Even if after the fact, if we're into July and we see that the market turned one way or the other, and in retrospect we determine it was a perfect, reliable forecast, at this present moment, having seen projecting out to the future, I don't know if it should form or will form, if it would at all, as either a top or a bottom. I might reasonably surmise and approximate in making certain assumptions to that, given the trajectory, the course, as we get closer and closer to this date. In other words, obviously, common sense suggests if we're declining, I would more readily assume, and I emphasize assume, it would manifest and create a bottom, and vice versa. To the extent I see price bidding up into the June 16 date, I might reasonably more greatly assume it could form as a top. But those are mere assumptions. And there are a lot of factors that could deviate from the real outcome relative to a precursor assumption. And then subsequent to June 16, July 2nd. That's an interesting little few days before a holiday. Anyway, so if nothing else, at minimum, understanding and an awareness of these dates out in the future as corresponding to rotation points, or more generally, more correctly, if I'm choosing to be a little more precise, stated as points in time for which I would expect the market will be more susceptible to componentry or changes in the attributes of its behavior, one type of which is reversal. That's all it tells me. To that extent, I have an awareness versus the traders to my left and right that are unaware, are not similarly aware, is the extent to which I might accrue some advantage. And also it might be provide a stronger impetus for me to look for factors that would corroborate and be congruent and supportive of my increased expectation for a change of some sort to occur. Anything from A to Z, whether you're a fundamental, quantitative, technical. Do I see a market when it arrives closer and closer, the day before, 3 days before, a minute before June 16th? Am I seeing extreme conditions as observed by an oscillator, overbought, oversold, price volume correlations, candle formation, you name it, everything from A to Z. The entire analytical repertoire is replete with indications you can look at. To the extent you can amass and strengthen and aggregate the the collective of all the information is the extent to that points to a given finer, more narrow view is the extent to which you can assume the odds are in your favor that you might have a correct view. All right. Connections, just a general review of more specific intermarket and intercapital market sector correlations. If bonds go down, if bonds go up, then what happens to the currency? What happens to some representative capital market sectors? Energy, oil, metals, and hard assets and stocks, paper assets. So I brought this slide into view at this point in the presentation to reiterate my bias as we speak. I am bullish bonds, and on that supports my thesis for at least short term. Short term in this case, my window of time to be specific, going from the general to the specific pertaining to the U.S. currency, 2 weeks into the Fed meeting. It's a convenient event that I'm aware of and that everyone's aware of that's following that in this realm that is consistent with all these disparate relationships. So I expect bonds. I'll come to that in a second, but at least bonds are going up and have been for the last few weeks. They broke through a significant zone of resistance yesterday. Either yesterday or the day before, I can't recall. I'll look at the chart in a second. You'll see it. And further declines, having broken the dollar in particular, having broken through that significant 88.6 Fibonacci level, and not only breaking through but closing, clearly indicates lower prices to come in the immediate future, as well as, and for other reasons that I'll allude to in a minute, longer term, through the third quarter to be precise. Short term and long term, if I define short and long as follows: short term the next 2 weeks, congruent with the Fed meeting, the FOMC, and longer term through the end of third quarter, September, into the September time period. Oil, the theoretical is for oil to be supported, weaker dollar, because oil is oil priced in dollars worldwide, globally, and that would be price supported. For other factors, that's I'm not talking about oil at the moment. That's there are going to be other factors. I could spend another hour on that. I won't, but just the shale production in the U.S. from a supply demand, I expect will put pressure on that. Regardless of the OPEC meeting, was it not last week, the week before, where they've agreed for a 1.8 million per barrel per day production cut. All of that has already been discounted in oil prices. That is, again, a fundamental development, which I think much has been discounted already by the appreciation we saw. But I expect pressure on prices given what is becoming of greater of importance in that energy sector is the technological advances in the U.S. that have allowed for increased rig counts and productions, and that's putting pressure. And as such, I expect oil to stay more or less in a range. Appreciation in metals, gold and silver. We broke through significant, in both cases we just broke through in the last 2 sessions, significant zones of resistance, and that's consistent with higher Treasury nominal prices, lower yields on all aspects of the interest rate curve, and again consistent with pressure on our currency. Rising stocks, which is going to, I do for the long term, I'm bullish the stock market. Short term, and that's the trade of the week, that correlates, even though it's not pertaining to the dollar. The final slide will speak, and I'll speak to that. So this is my view, the focus in particular regarding how it affects the dollar. If bonds rise, meaning expecting an environment of lower interest yields, okay, Wednesday and Thursday, and even further, I didn't check the numbers yesterday on the yields, but I know from Thursday, or from Wednesday to Thursday, the 30-year yield went down. It decreased from about 2.2% down to 2.15, and the 10-year note, on the 10-year note, that is, on the 30-year, the yields declined from 2.86 to 2.81. So that is, as interest rates decline, or the as bond or Treasury yields decline, that's going to correspondingly put pressure on the U.S. currency, on our dollar. Okay, and so that speaks to that relationship. Using your interest rates to track the current level and and to kind of get a sense as to how we might expect vis-a-vis this chart. If bonds go up, that is the nominal price, not the yields, because there's an inverse relationship if you're, as long as you're, I assume you're familiar with that, but if not, that is the case, more or less. All right, so here's this horizontal line is the level that I just mentioned of what was resistance that we clearly, easily, just blatantly broke through yesterday. This is the 30-year, this is a daily chart of the 30-year Treasury bond, the front month, the June future, and the bonds. So you can clearly had a blast off yesterday. It's curious, interesting that I submit it's not coincidence that the close was exactly at the 61.8 extension of everything from this bottom here. That's why I drew in those lines there and pivoted off this bottom. You have a classic zigzag. What does this say? Well, if it's a perfect ABCD, AB equals CD zigzag, stereotypical lightning bolt, that augurs for a takeoff for nominal treasuries, 30-year bond prices. Go long bonds, if you're not already. The people I've been consulting for months have been long in the bond market. I got long back in here, I made a little money and then got stopped out in this decline here, and then re-entered. Well, I'm long, suffice it to say, all over the place. But if one were on the sidelines, on the breakout of yesterday, of this level right here in the 30-year Treasury, when you broke out about the above the whatever level that was, 156 area, we settled at 156 area. That was at 155.16. I just remember now. Yeah, this level, this high was exactly 155 and a half and 16. Bonds are traded in 30 seconds. And so I was saying for people, some people were asking me last week, do you want to buy bonds here? Well, you could have. It was just a riskier play given that it was just, you don't want to buy in principle directly below resistance. On the break, so I said park your buy stops just above that. So anyone who did, you created, if you're a short-term trader, you created some distance. If you're a longer term, well, you're in it for the ride. And again, given all variables that I'm aware of, I expect further appreciation. I'm not saying we're going to necessarily guaranteed get up to 100% extension creating. If this is A, this is B, this is C, theoretically an ideal zigzag works on the theoretical equation of CD. This move from this bottom right here, first week of May, or May 8th or so, or second week, whatever, through where we are, is the formation of the final leg of that zigzag, the CD. And ideally, a symmetric formation would be CD is such, its length, its extent, will be equal to this. And that brings you up to this level of just under the 160. Well, that can occur. I'm not saying it will necessarily. I'm simply suggesting theoretically it's possible, and it would be consistent with a symmetrically formed zigzag structure. But not always will that be the case in the real world. There are other mitigating factors. Again, as we get closer and closer to the Fed meeting, I admit I'm deviating from my pure technical view. I'm incorporating and taking into account and cognizant of a fundamental factor, the Fed, the FOMC, what they do with interest rates, that could dampen my enthusiasm for continued appreciation nominally in the event they raise rates. Nevertheless, technically, the fact that we broke through is certainly price supportive. So that augurs for long structure or long positions currently in the bond market. Now, and this might seem, if you're not aware of the relationship and the correlation, absurd on the surface. I'm talking about financial markets, or have been at least up till now, and all of a sudden I bring in an agricultural commodity. Beans in the teens is the old cliche. When I started more than 30 some years ago, when I was working as a broker, I remember in my first, when I was getting started, I would hear on the floor traders talking about beans in the teens as if it was, something, it was just a mantra. Here's the point and the reason why I've indicated, again, what on the surface might seem completely foreign to the financial or paper assets and interest rates. It's an agricultural commodity. Well, there are correlations where you might least expect them that are very powerful. Suffice it to say, for various reasons, and actually a currency, a forex trader years ago kind of gave me insight as to this. Soybean prices are in very interesting ways correlated to inflation. And directly so, not perfectly, but more or less in a direct fashion. Falling bean prices indicate are in sync or running in synchronous, correlated directly with lower inflation. Rising, the opposite. When bean prices go up, you correspondingly 80% or so more of the time see increases in degrees or indicators of inflation. So you can see, let the chart speak for itself. A picture is worth 1,000 words. So from this chart, clearly, most recently, if we discount everything from back here, that was clearly a bullish move, and this was a bullish move. But if you look at the entirety, short-term, long-term, overall, it's more bearish, clearly. And more recently, it's bearish, up until yesterday. But again, if nothing else, and not looking at the detail, just encapsulating and taking a look at the bigger sense, it's indicative of a lack of inflation. And the significance of this is it would be an indication that would, in the totality of events, be a disincentive for the bank to raise interest rates. And if we have soft monetary policy, that would be another factor, though in and of itself certainly woefully insufficient to generate a view for a particular sector, the dollar in this case. But to the extent this is interpreted or looked at as a component of projected future inflation or lack thereof, to the extent my takeaway from this bean trajectory, soybean, a commodity, an agricultural commodity price, would indicate there would not be there is no near-term indications of significance indicating upticks in a significant way of inflation. And as such, to some extent, I might expect there would be a disinclination on the part of the bank to raise rates, and thus that would provide a further obstacle for further or a reversal in dollar, or it would be unsupportive of further appreciation or bidding up of the dollar. It would push dollar values down. This is another take on the soybean chart. Maybe that's about to end. This chart, from a pure trend standpoint, is clearly bearish, consistent with the previous slide. Lack of inflation, to the extent I consider this particular very specific correlation between inflation and bean levels and bean trajectories and its current momentum. However, yesterday was a key reversal. That's a small point in and of itself. It's certainly, in this case, it's a reversal indication, since the trend preceding it, the entirety going back 6 months to the beginning of this year, has been bearish. The fact that yesterday's action was a key reversal at a bottom is by itself a bullish component. Not enough to go long in and of itself, or at least I wouldn't, but certainly it is a bullish vector that we would want to take into account. Could it be that we are at the end of what has been a multi-year, long-term, obvious decline? I don't know. What I do know, and this is why I presented this, and this is why I titled this, Well, Maybe, this is a very rare commitment of traders relationship. If those of you are familiar with the COT, the COT report, commitment of traders, just merely an accounting, to jump to the end result here, this red line, if you can see it, represents commercial positioning. They account for between 70 and 80% of the volume you see at any market, any derivative at any time. Okay, that is what it is. What I want you to see is, notice since the beginning of the year, the first quarter, back in February, where they were net short. Notice the scale on the right, 0, and everything above it is net long, represents positive net long positions. Everything below 0, this vertical axis on the right, everything represents a net short positioning by varying sectors. The government, the CFTC in particular, Commodity Futures Trading Commission, divides all market participants into 3 categories. You're either commercial, and that is what it is, what it states, nominally, or you're a speculator, large or small. I don't want to get into too much detail. What's important here is we have an important right now relationship. It's important because it's very, very, very rare. Often you see, whenever you have a commercial at an extreme, which they are at the largest net long, that by itself has future implications for the market. It's saying, and there's usually a lag period. Now here's where it gets gray. It gets a little ambiguous. The study itself and the varying interpretations, and traders through the years have developed all sorts of ways to kind of more precisely, in a quantitative, objective manner, define as best as possible what is the lag between what it is that the commercials are doing and the market itself. And that's where some uncertainty. The report itself doesn't give you insight to that, and as such, by definition, you need to utilize and amend the report's interpretation with other factors that help you with the timing. All the report does is give you a qualification by reading what the commercials are doing in specified ways as to the future course of more probable action in the market. So without just simplifying it for the moment for time consideration, the fact that the commercial since February has been moving up in their net positioning. They went from a net short to a net long, and in the extreme, in the limit, they are currently at their largest net long that they've been in for the last 4.5 to 5 months. That in and of itself is bullish. That's not why I'm interested, and that's not why I presented this slide for your consideration. What is extremely rare, that happens all the time. For any market, it could either be one where it's extremely bullish, or if it was the opposite, in the extreme net short, it would be extremely bearish. That's fairly typical, if it is. What's of interest and what sticks out is most frequently, whenever you have the commercials at an extreme position, such as you have, again, typically the market's doing the opposite, with the interpretation being whatever it is that the commercials, once they have achieved this extreme position, position as far as their trade positions they've established in the market, once given a certain amount of time of lag, I minimally allow for about 3 months, let's say, and that's the question mark, a big question mark, and that's where you have to bring in other factors. But that's by itself pretty basic. But typically you have the large traders. Large traders are the green line, if you can see over here where it's not in combination with the blue. You have 3 colors. The red line are the commercials, green are the large traders. What's a large trader? Well, in funds for the most part, big money. Commodity pools, mutual funds, hedge funds, investment banks, etc. It could be individual traders. It's a function of any entity that's trading more than 100 positions per time is, I think, from an accounting standpoint, considered a large spec. You see, typically when the commercial position is at an extreme, either net long or net short, whatever it is, the large trader position is often 80% or greater of the time the polar opposite. That's standard par for the course. Nothing unusual there. I don't get excited about that. What is extremely rare is when you have the commercial, as graphically illustrated by this red line again, in an extreme position, and you have a mirror image not by the large traders but the small traders. What that does is it attaches exceedingly greater import and credence to whatever the extreme position that the commercials have. It is very, very rare. People write books on this. I go into the reasons. Just one little point here. 80 to 90% of the time, whatever the blue line is doing, that is the small retail trader, they're wrong 80 to 90% of the time. So that's part of the rationale as to why this is such an important indication. Would I place a trade and establish position solely on this relationship? Probably not, but in aggregate, again, with everything else, it is a factor to suggest the possibility of rising bean prices, which, to the extent we are looking at beans as a possible correlate harbinger for inflation, that is supportive of a price supportive projection for the U.S. currency. Just saying. Just wanted to indicate that. I wanted to be, this is an argument, this slide by itself is an argument for the future. Again, what I haven't indicated precisely is any specificity as to the timing. I've already said short term, and I'm defining short term for the moment in this context, the way I'm defining it by definition here, between now and the middle of this month, I expect further, more likely, the trajectory for the U.S. currency lower because of, and then because given the uncertainty of what the bank is going to do with interest rates. I'm about 80% of the view that they will rate increase at the meeting in 2 weeks. That would in turn be consistent with the precept that this screen is showing in the price action correlated with the relationship between the varying sectors that populate and create the motion we're seeing in the chart. My longer term view for the dollar is for other reasons still. The longer term meaning through the third quarter, still bearish. Could it be that this relationship, as evidenced by the sector positioning, is being such a rare relationship? This happens there are 50 or so liquid derivative markets that are actively traded in the US. This relationship between commercials and small specs, where they are more or less, it's not perfect, but more or less perfectly mirror image. I don't know if it happens, 1% of the time in a year, for considering of all those 50 markets. Very rare, very powerful. I know traders, Paul Tudor Jones made hundreds of, this is a potent relationship. It causes me to pay attention. Again, not saying it's sufficient for me to abandon my preceding dominant current view of the bearishness for the U.S. currency. It is something, it is a contraindication of possibly expectant catalyst that might serve to eventually, as we move forward into the final quarter, if I'm correct, turn the course of the dollar around. Something to think about. Finally, from a practical standpoint, wrapping up today's presentation, given my qualitative expectations for further price declines in the U.S. currency, there's a practical note. The dollar index, historically, how do you trade it? What instrument? Well, there's all sorts of ways. If you trade stocks, if you're on the securities side, you might, there are ETFs like, that represent and correlate and map the U.S. dollar on currency prices. You could do that. I would be disinclined to trade the future, the DXM symbol, simply because it has been historically a little volatile on the one hand. Volatility by itself is not bad. That's a very good thing. A lot of traders have that incorrect theoretically. Volatility is not the nemesis of you, the investor, and the trader at all. The old normal distribution paradigm would have us believe that, but that went out 50 years ago. The nonlinearities mixed with linear price action clearly allows for a broader market view. The Pareto-Levy distribution model, I think, in cases and suggests that volatility is helpful. We need volatility. That's why I shifted. Anyway, here's the way. If you're a trader, you want to indirectly trade the U.S. dollar given attributes that make it less than optimal for as a vehicle instrument to trade. I would trade the Euro USD as a correlate. In other words, to the extent I'm bearish on the dollar, as an inverse way to indirectly exploit my expectant declines in dollar values, I'm going to establish long positions in Euro USD as indicated. And for other reasons, I happen to expect further appreciation similarly through the third quarter or so for the Euro USD Forex pair. This is an indication. Clearly, yesterday's action, this was printed out last night, clearly you broke through in the Euro USD significant resistance in the Euro USD. And we're trading, we closed yesterday at the afternoon Pacific time in the Euro at 112.80. Given the break of that through that resistance, I can see that the market has set its sights on the loftier 113 area. So this is a way indirectly you can exploit a bearish view in the U.S. currency. For a host of reasons just on the Euro, we're clearly above the 200-day moving average, the gapping up, etc. That's one way. If you're more comfortable with securities, locate a good ETF, FXE, FXY. I don't have the symbol in my head at the moment. I don't trade ETFs in my own accounts but there are a few liquid ETFs, exchange traded funds, that track US dollar and currency values directly. Probably from a practical logistical standpoint, a better selection to exploit your view in the dollar. Lastly, just a final review. Again, I'm bullish nominal bond prices because I'm expecting yields at least for the next week or two, given what we've been seeing for the last few months, decline. What happens at the meeting is a little uncertain. I believe that even though the most recent spate of economic data fundamentally has indicated less than ideal, slowness of growth, jobs growth has declined with the latest numbers, the non-farm payroll that came out yesterday, and yields have been dropping concomitant with that. Inflation levels are still under the Fed's target of 2%. Payroll gains, I think for May, came in at 138,000. That's less than expected. All of this, the confluence of all of these indicate a slowing, this is soft and would be a disincentive for the Fed to raise rates sooner than later. I feel, 2 weeks ago I was of the view that there was about a 90% certainty the Fed would raise rates in the June meeting coming up in 2 weeks. Now, I'm still qualitatively of the opinion that they will raise rates, but I've reduced it to about 80%. I think the data will be viewed by the bank such that they will feel they have license to raise it in June, but possibly delay what was previously thought would be the next rate hike in September. They may delay that for the end till the December meeting. I think that's how they may handle it, but that is uncertain. If you can read through the informational equivocation on the part of the central bank, Janet Yellen in particular, you're better than I. So in lieu of that, this is why I go and look at the charts. Final point here, and this is not particular to the dollar, but it is from an inner market. It's clearly the stock market. We've been rising, breaking, falling, forming new highs in the last few sessions. And the trade of the week, which is you can think of it as a correlate, and for reasons, some of which are correlated, some of which are altogether, at least on a topical level, a field light years apart. I believe all things are at very deep levels, that the cyclical componentry, which I believe is the ultimate instigator of all price action, are tied together and in touch. But having said that, I established just a very specific trade and potential contingency orders. I am looking to go short in the stock market. And you might say, wait a minute, I mentioned that to someone I was consulting yesterday, and he said, Glenn, look at the trend, it's going up. Clearly from a trend standpoint, I'm bullish the market. And longer term, going out for the next few years, I am quite bullish stocks for reasons we won't get into, a host of them. But to keep life simple for the moment, clearly the trend for since the election, November 9th, the market liked the results of the election, regardless of your political biases one way or the other. The stock market, that is in the U.S., has been rallying, you can see, for the entire year. So on a pure trend, I could list a number of reasons that are price supportive and why one would theoretically expect further appreciation in prices. All of which, otherwise I wouldn't be doing and saying what I'm about to say, are overwhelmed by the confluence, again, of a timing factor. I have, suffice it to say, 7 different cycles, the epicenter of which are right now. June 3rd happens to be today. The final one coming in on Tuesday, the 6th of June. We are, suffice it to say, in a critical window of change based on the relationship as to the interaction potentially that can occur, the reaction that can occur when a market runs into time, when it's run out of time. What did W. DeGan say? When a market will do what it's going to do, whatever that is, once it is time. Until that time has come, a market will continue on its previous current regime. Unless and until a market has run out of time for a given regime, it will continue. Once it has run out of time, cancel Christmas, as they say. And I believe we are at a critical, ultra-critical window I put out of time. And emotionally, it might be very difficult to play the contrarian card. But there are ways to modify it and lower the risk. I'm not saying go outright short the market. You could. It's just a riskier play. Strategically, there are many ways to exploit what my expectations are. I'm expecting a reversal. Now, remember, I'm simplifying. One type of reversal is what, in a language sense or semantic sense, would be interpreted as a continuation. I'm allowing for that possibility. That's why I didn't sell the market directly at the market. I have worked sell stops, a couple of zones of support below current prices. The S&P, this is the daily chart of the S&P, closed yesterday at 2437. The Dow, all major indices in the U.S. have achieved all-time historic highs with the last 2 days of price action. This was the May 25th little top here was the preceding high, at least in the S&P and the Dow. I'm not sure on the Russell and the NASDAQ, but for the most part, then we, for 4 or 5 days, consolidated sideways. That in and of itself is bullish. 70% of the time, you have a big move up from this bottom here, like you did that pivot point bottom, period of sideways consolidation. Whenever you're in a market's in consolidation, more often than not, 70% to be precise, it breaks in the direction that it was trending prior to the period of sideways translation. And we've seen that. I'm not surprised. The question I ask is, what is a market doing? What is its angle of approach at the time it reaches the time point that it's running out of? Well, in this case, it's going up. That makes it easier for me to ascertain the probability of a reversal is imminent. And in this case, I'm not certain, and if I were certain, I would have gone short at the market, because one type of reversal could mean, if I stretch the definition for what the word or concept of reversal encompasses, to include a type of continuation, albeit in a different way. It could be that the market keeps going higher, but at a different velocity. It decelerates or accelerates. That I'm not certain of. But for a lot of details, I have about a 75% bias to expect a decline, a nominal decline. Still 25%, it could be a reversal of a continuation type. Thus, if you want to play this conservatively, do a straddle. Buy calls and puts, same strike, similar strike, same expiration. One of them will, given my over 90% expectation for a surge in volatility, in other words, translated plain English, something will happen, and not such a commensurate degree of certainty as to the directionality of what will happen, say 75%, if you want to play it close to the breast, safer, more cautious, employ some type of straddle, a strangle if you're a little fancy, etc. Or if you're trading the underlying, you could do a contingency play. You place your buy stop above resistance where you project it on the screen, and you simultaneous sell stop on an OCO basis. One of those will, given enough, if I'm correct in my projections of analysis, will be triggered, and then you can modify the trade to make it as efficient as possible. That's the trade of the moment. In addition to, had I been at the time a week and a half ago when Pacific Trading asked me to speak, I wasn't thinking about this, even though I've been preparing. I've been projecting these time points for going back at least 2 months. I was just thinking about the Fed meeting coming up, and as such, I thought it was a very relevant topic theoretically to discuss the course of the US dollar. As it turns out, as the week presented, and I actually just literally on Tuesday focused on 2 particular cycles that have their center today, June 3rd. I was not aware of that 2 months ago. I was aware of the other 5, and that's why. Had I known about that, I probably would have, the entire topic for today's presentation would have focused on the equities market. Nevertheless, that is a trade commensurate with my looking to go short that I would just play indirectly in the US dollar. If you have further questions, folks, or any questions, I'm going to take a minute here because I covered a lot and I didn't take time out as I should have. I get invested in my slideshow, and I forgot. So I have a few minutes here, and let me backtrack and see if I can talk and address any of these questions. Okay, doesn't look like there are many. I have stocks and bonds going in the same direction. That's only one. Okay, so let me see. Ed is asking, and I think you're referring. Let me back up to I think what you're. Oop, let me just see here if I can grab my. Okay, I think what you're stocks and bonds going up. It's a tricky relationship. There is a phase of difference. Bonds, the basic way, Ed, you want to think of this from an intermarket correlation standpoint. Bonds, in a sense, or the treasury instruments, bonds, notes, etc., any financial interest rate market, you think of it as the cost of money. It's a packaged form of the cost of money. Interest rates are a direct numerical indication as to the cost of money. So we're commoditizing a bond, a treasury instrument obviously is like a commoditized loan in a sense. Okay, so if bond prices go up, meaning more money is being loaned out, it facilitates growth and capital appreciation, that is in corporate America. And so that's helpful. That improve, to the extent I can increase my capital acquisitions if I'm a company, a corporate entity, that increases my potential and propensity to increase my widget production. In turn, that I can increase my revenues, and in turn I can my bottom line is improved. My stockholders are happy. My payout dividends, stock prices appreciate. Given lower yields, higher bond prices, because there's an inverse relationship, and I'm oversimplifying, but that's not to the more for the point of conveying the essential true thrust of the relationship. Bond prices go up because the cost of money goes down, which is as reflected by an interest rate or a yield, let's say. There's a distinction there, but just to convey the generic concept in a very basic way. When bonds increase, it means that more money's in the system, more money in the system at lower borrowing cost. If I'm a corporate treasurer and we want to build a new factories that can employ people and enable our production capacity to go up, and I check with my local banker and he says, oh, now's a good time because the interest rate I'm going to charge you is going down, I am more inclined sooner than later to get that loan. So we can start digging and build a new factory. And in so doing, project out 6 months, 6 years, etc. A pattern of growth as facilitated by lower borrowing costs tends to rev up the economic engine. People go to work, people spend, the economy is moving along. I'm increasing my revenues and my profits increase, and the stock goes up because people see it. And there's a feedback loops and all sorts of things. This tends to have the net impact of bidding the price of stocks up, all because bonds go up, and bonds go up because loans get cheaper. So out of that, and more detail, that's a simplified view of the relationship that is often at play between the bond sector and the paper equity sector. Bonds are perceived as a starting point of analysis to lead what you see in the bonds, think about as a leading harbinger, if it's not occurring already, for what you would expect to see in stocks, because of the interlinkage set of events that I just indicated in isolation. There are other factors that modify in a more nuanced way, but more or less starting from the simple and utilizing that as a starting precipice from which to interpret why these things occur. If that's what you were meaning, because you stated a point saying in your point, you just stated as a statement, I have stocks and bonds going in the same direction. Clearly, yes, given, and so that is one of the reasons why. And on the opposite side of this slide, if bonds are declining, well, let's ask ourselves why bonds are declining. Yields are increasing. They are inversely related. If the bankers, if the people who make the loans, who have control of the funds, the energy, are tightening, are being more restrictive in their lending policies, if they raise the rates, I individually and you corporately, or any entity out there in the world that is in need of financing, if the financing cost is too prohibitive, I will be disinclined. I'm not going to borrow. Therefore, I have to delay. Instead of building that new outlet and employing people and building my factory, I have to forego and forfeit on the front end my extra revenue. So I'm not going to make as much money because I got to wait 6 months, a year and a half until I expect the price of the loan to go down. Then I'll get a better deal. I can then get my loan. I can then build a new factory. I can then increase my revenue. But until that time, revenues will languish, and that's reflected by my dividends and in my stock value. Investors don't like me as much. Stock traders sell stocks, they get out, and that pushes the stock price down. I'm simplifying. There are many other variables that more finely define that relationship, but in isolation, starting from the simple first, that's a logical explanation. Further, let me envelope or put that into a greater context. If you want to get a sense of what bonds are going to do, bad news is good for bonds. Good news is bad for bonds. Anything negative and in a common sense way, anything bad, war, disruption, uncertainty, that's real good for the bank. Because of this, the central bank, which serves as has as its mandate. Well, they shouldn't be political, but there's theory and then there's the real world. Anyway, that's a way to interpret. So anything that would be disruptive, negative, bad, financially, economically, militarily, politically, any uncertainty, any disruption in anything deviating from calm, peace, serenity, etc., 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 that you can expect will be price supportive for Treasury instruments, i.e. notes, bonds, bills, etc. Any instrument that's built on an interest rate or a financial or a function of the level of cost of money, as indicated by levels of yields and interest rates. Stocks and the currency tends to be the opposite, because the currency, and it's a more subtle relationship. On the one hand, rising rates for the currency have a knee-jerk immediate response to strengthen the currency up to a point, and for a number of reasons. You raise the rate, you decrease the monetary supply, the lesser number of units of that commodity in circulation, the more valuable each one becomes, and thereby it also attracts investment from all sources, internal, domestic, as well as global, foreign, on the one hand. On the other hand, if you raise if you increase the value of the currency, i.e. in this case the dollar, let's say, too great, too quick, and too far, too high, it immediately, by by definition, dissuades or discourages investment, or it makes it too prohibitive. You can't invest, you can't get loans to build, and that in turn can longer term slow things down. Thus the quantitative easing started in the US in direct response in an effort to get ourselves out of the recession from 10 years, 10 years ago, 2007, 2008, and in follow through throughout Europe and Asia, that they're only now beginning to ease out of. And in the European bloc, they had further complications because of the Brexit situation. That's another, all of these things, but all of that. So I don't want to, I want to get back to your question, Ed. More or less as a starting relationship at least, but you have to factor in other forces, but as a start, in general, what you're seeing in I typically will utilize the bonds as a leading indicator of equities, the stocks. Also, there's another relationship, capital flow. Traders and investors on all time windows, long-term, short-term traders, all the way through long-term portfolio investors in stock market. When stocks don't do well, for whatever reason, money comes out of equities, where does it go? Well, 50, 60, 80 years, you know, the early part of last century, early 1900s, traders would go into precious metals, gold and silver, as a hedge against uncertainty, calamity, decline, equity prices for whatever reason. And then the problem with that was metal, gold and silver, platinum, etc., primarily gold and silver, are non-performing assets. It's hard, you know, until people like Warren Buffett came along and showed how you could create rental income in a figurative sense off of metal. You can write option strat, all sorts of things. And so what has usurped the precious metal sector as the next stopping point from a capital flow standpoint when money comes out of paper assets, i.e. stocks, is the interest rate market. So that's another reason why you have a relationship between bonds and stocks that's inverse, different relationships. So depending on what's at play, what forces are dominant and vectors financially in an economy are at play, and you have to look at the resolution of these things. It's a more difficult thing. This is why one of why I tout the technical approach. You may not be aware, or even if you are aware and understand some of these basic intermarket and fundamental correlations between the different capital market sectors, even to the extent you understand theoretically what's going on, the complexity of what can happen at any given moment, and adding further the corresponding collective response of all traders. The collection or the collective response as evidenced by the sum of all the orders that is impacting all these different markets at any given time itself becomes a separate fundamental that you should factor in. Anyway, that's very, 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 you can get mired down in detail. But often the chart interpretation, i.e. the technical approach, will enable you to have a distillation and a clarity, and then that will, that you may not have an explicit sense as to this event specifically, but at least you have a generic predisposition for the type of things that you would need to see in the world, i.e. news, that are going to be in concert and in alignment with what your charts have already told you. And that's the approach I typically take. Okay. Great, folks. I'll call it a session. Again, if you'd like to review any of the relationships, let me backtrack to our contact information that I've presented. If you missed it, or if you'd like to review, or if you'd like to get additional information on any of the programs that we offer at Pacific Trading Academy. I have about 13, I think I have about 11 students right now. I could probably take a few more, I don't know. I don't like to have more than 15 at any given point. But ask for Peter Newman or Frank Cameron or Susan or anyone in the office if you have interest in any of the tutelage or mentoring or teaching or coaching programs that we provide. Here's the contact information again, 800-339-8588. You can access the website, which is, as you see, www.pacifictradingacademy.com. And also I'm not sure, the computer department used to send everyone who subscribed a copy of the recording of the presentation. Whether they still do that or not, I don't know. You will find out. If you want one, suffice it to say, you can just contact us and find out how to achieve it or receive that if it's not automatically sent to you. But again, hope you've gotten something out of this, and it was fun for me, and I hope it was helpful and to some extent for those of you who are present. And until next time, wishing you a great weekend and profitable trading in the days and weeks to come.